Welcome to part 3 of our seminar, Understanding Financial Statements. In this video, we discuss the reporting of the current asset prepaid expenses. In addition, we describe 3 asset classifications: current assets, investments, and property, plant, and equipment. Please make sure to print the PDF handout found below this video. We will be referring to the PDF handout throughout the seminar.
Okay, prepaid expenses. So these would be costs we paid in advance. The classic is insurance. We get a premium notice, it's for 6 months of insurance, right? So let's say on March 20th, I got the notice for the next 6 months of insurance, April through whatever, 6 months. I pay for it in March 29th, but none of it is used up in March. None of it expires in March. So rather than expensing that whole insurance payment instantly in March and distorting my financial statements for March, I'm going to defer it, we say, and I'm going to list it as a current asset. And then each month, I'm going to move 1/6. If it was a 6-month premium, then every month I'm going to move 1/6 of it out of this prepaid expense area and stick it on the income statement under insurance expense. Okay? So that's what's known as adjusting entries.
Okay, let me make sure I understand.
Sure.
This prepaid expense right here is the whole total insurance amount for 6 months, but using that as your example?
Well, it's the, yeah. So the question is the $11,200 the total amount that we paid for insurance for the next 6 months? And the odds are it's not. Because every month, of course, this is going to go down by 1/6, and there might be some old policies that are in here, and there might old policy premiums that we paid at a different time. So they might not all be coordinated. Or maybe we paid a huge fee to our trade association, and it covers the whole year, and we didn't want to sit that whole big one payment into 1 month's income statement. So we deferred it instead of as a prepaid. It's covering our membership dues for the whole year, and then each month we'll move 1/12 of that annual thing out. So we don't know that it's just one item sitting in there, right? So in my case, in my explanation of, or my example, it would all have to be in there right now because we wrote the check on March 20th or so, and it's for the April, the period starting with April. So in my example, all of that has to be in there.
Okay.
Now, next month, it's going to come down by 1/6, and the next month it'll drop by another 1/6, and at the end of 6 months, it'll be pretty close to zero, right? And after 5 months, it'll be 1,000, but then I might pay the next 6 months, so it's going to be hard to tell exactly. Okay. All right, so we're now going to look at the total current assets. So we sum up those 5 items there, and some people would say that's the amount of liquid assets. What the bankers and others are going to do are they are going to compare that total current assets amount to the current liabilities, which we'll see later. And if that'll tell people like your bank, here's how much cash they expect in the next year, and then they're going to look at the current liabilities to see how many dollars have to be paid out in the next year. And if a company has more current liabilities than current assets, boy, that's bad news, right? How are you going to meet the payroll? What are you going to do? And of course, that's a general ratio or rule. What we really have to do is look into these individual amounts here, right? I mean, if we have inventory of $350,000 and 100,000 of it has never moved in the last year, what are the odds that is going to move, right? So we have to be careful, right? And the accountant is supposed to help us by saying, you know, if it isn't going to turn to cash, I'm going to have to decrease it to a lower number. Now, not all accountants, or let's say the person at the company decides to do their own financial statements with their own software, and an accountant is not involved, then you might say, wow, I wonder if that inventory is any good. What if it's all obsolete, deteriorated? And so, gee, I better have some more information on that inventory. And so there'll be another ratio called inventory turnover that might give us some more insight. Same with receivables. Are those receivables being collected, et cetera? Okay, so we finished the current asset section. Now we're going to go to the next groups of assets, and these are basically the non-current then, right? So the current we're the first 5 items. Now we're down to investments, which is really a long-term asset. Right? If it were a short-term asset, you would have put it under temporary investments. So if you have a long-term investment, it goes in this classification that shows the bold word investments. And this includes more than securities. It could be the cash surrender value of a life insurance policy that the company owns. It could be some cash that's restricted for something and it's not going to be available for use in the next year. So that's the section of investments. The next classification is property, plant, and equipment. And property, plant, and equipment is sometimes known as the fixed assets or plant assets, and we often just use the acronym PP&E. Now the land is shown at $12,000. That would be the cost of the land when it was first purchased. And if that land is in the right location and was bought a whole lot of years ago, that land's worth a whole lot more than $12,000. But accountants cannot show the current market value because we've got the cost principle. So cost keeps us from showing that at more than the original amount. And land does not get depreciated. We don't systematically send that to expense. Now, I think we probably have another principle that might explain why the accountants stick with this cost, and that is objectivity. If we started putting down what we thought it was worth, pretty soon the accountant can't verify the number very well. So accountants do audits and they like to verify numbers, and cost is really verifiable. The market value would be more helpful to your banker perhaps, but it gets to be subjective, which goes against our objective motive. So we're trying to be as objective as possible, and we tell you up front, we've got the cost principle. That's one of our generally accepted principles is cost. So if you want to talk to your banker about a loan, you better take in an appraiser or an appraisal of the property, right, to help get your loan. Because this alone isn't going to work, right? You can say $12,000. Then you say, oh, by the way, 2 interstate highways now go by and there's a major chain next door, and now the banker is going to talk. But just having this balance sheet with the original cost isn't very helpful. However, it is very objective, it's verifiable, and so we stick with cost. Okay, land improvements, these would be things that we're going to depreciate, things that aren't going to last forever. See, the accountant is assuming that land will be there forever and the cost is good enough, don't depreciate it. But when we start putting in driveways and parking lots and some special landscape stuff, outside lighting, that is not going to last forever. So anything we construct, we're going to have to depreciate. So land improvements has got its own category. Then we go to buildings, which should be pretty understandable, except we don't put the land that the building sits on there. The land gets separated. So if I buy a piece of real estate today, this business buys the real estate today, this building, real estate transaction, and they get the land with it, we got to separate out the land piece. So let's say the transaction was $1 million to buy a building and the land. The accountant has to figure out what is the cost of the land and what is the cost of the building. And the cost of the land goes up to the land account and the building cost stays here. And then only the building cost can be depreciated. Okay? And the accountant will get some guidance on that. Maybe the appraisal report will direct the accountant as to how much of that cost. So we're going to still stick with the cost principle of $1 million, and then we're going to perhaps arbitrarily say 200,000 of that is land, and then 800,000 is building, and then we'll depreciate the 800,000. And of course, that example doesn't tie into these small amounts here.